Hello, Adam Gower here, and welcome to the Real Estate Crowdfunding Show, syndication in the digital age at gowercrowd.com. Now, before we get going, I'm going to start off by flashing back to the time shortly after I was fortuitous enough to sell my entire real estate portfolio in 2007, right before the global financial crisis that followed. And I was brought in via the board of directors to East West Bank to assist them with asset divestments, right? Basically, their non-performing loans, of which they had a few. And it was as I came to the end of that spell there, having worked on over $1 billion of notes, that I met with Goodwin Gaw of Gaw Capital, an amazing Hong Kong Chinese investor with an amazing vision and outstanding reputation. And Goodwin asked me to leave the bank to join one of his funds. Well, it was in working for Gaw Capital that I really learned what institutional investing was, what institutional investors are. And since crowdfunding has started, the term institutional investor has been bandied about a lot, right? You hear a lot, invest like an institution or invest in this institutional quality deal. Well, the reality is that it isn't anything like the reality. So I'm very pleased to introduce you today to my guest, Mike Hugh, who is the managing director at Gaw Capital Advisors, USA. So you can hear exactly what institutional real estate truly is. Now, before I turn things over to Mike, I just wanted to let you know that we are in the process of creating some new training for you so you can raise capital online, learn best practices. So please go ahead and sign up. It's not quite ready, so go ahead and sign up for the newsletter at gowercrowd.com. Select whether you're investor or developer. There's two options there. And I'll send you information on the new training as soon as it's ready. And while you're there at gowercrowd.com, be sure to go to the podcast page where you'll find links to my guest, Mike Hugh, to Gaw Capital, and a series of short video highlights from today's conversation. All right, now I am really delighted to introduce Mike Hugh, who is Managing Director at Gaw Capital Advisors USA, for a detailed discussion of what exactly is an institutional investor and an institutional investment. Mike, what a pleasure to see you. Thanks so much for being on the podcast from my old alma mater. It's really a pleasure. Thank you for joining me. Now, as I mentioned before we started, a lot of people in the crowdfunding industry like to use the term institutional quality real estate or institutional sponsor, institutional investors. Let's talk about that. Let me start at the very, very top. What is institutional quality real estate?
Well, no, Adam, I said we think of institutional quality real estate. We think of the major food groups. I think most in real estate private equity funds are predominantly playing in either one office, two retail, three logistics, or four multifamily. And those are the four sort of, I'd call it the major food groups where most of these funds are investing. We also do have, more specialty, or people are calling it alternative real estate, where they're investing in new product types like data centers, student housing, self-storage. So there's different types of asset types that people can invest in. I actually personally feel all of that fits under institutional quality real estate. I think everyone sort of can differ depending on what they think is institutional quality, because I think most people probably think of it as larger assets, like Class A office buildings, right? Or trophy assets. I think that's the average person probably looks at that and says, okay, well, I'm buying a small retail shop, right, that has one tenant. That's very different than buying an entire outdoor mall, right? And so I would say that it's the nomenclature people sometimes get caught up with. But institutional real estate to me can be anything from that, like literally from a Class A office building to a trophy hotel in Hawaii, all the way down to manufactured housing. And we've seen everyone do that across the board. In fact, actually, I was on a call earlier this morning and Sam Zell was a speaker, and he was talking about if you look at all the different things that he's invested in the public REIT space, it goes from manufactured housing to the equity office properties that he sold to Blackstone, and then to multifamily and industrial and stuff he's doing down in South America. So it really can range. There's quite a big range for institutional quality real estate.
Got it. Right. And we'll get into what is an institutional investor in a moment. All right. We'll talk about that presently. But first, if you were to walk into a meeting of institutional investors, you walk in, there's a boardroom, you're about to do a presentation, and you pitch, manufactured housing somewhere, right? Or a multifamily deal, or you were to pitch a Class C multifamily 10-unit apartment building, in the middle of nowhere. Okay, it's multifamily, but it's not institutional quality. So tell me, what are the characteristics? Really break it down for somebody who doesn't understand what the quality of an asset within any of those asset classes. What kind of characteristics do they need to have to be classified as institutional?
All right. Well, institutional real estate, we see it as sort of defined by three different buckets from a risk return spectrum. The lowest risk, lowest return bucket being core, then moving up would be value added real estate, which is sort of mid-teen type IRR returns. And then you've got opportunistic and sort of the higher risk, higher return bucket. We think that there are different characteristics. I mean, real estate can be single family homes right now are viewed as institutional real estate, and institutional investors are investing in this space. So it really, I think that getting caught up with the definition of institutional real estate is sometimes can be misleading because it's really about sort of scale and size. So buying one single family home, may not be viewed as an institutional real estate investment from, like a typical institutional investor, but buying 5,000 single family homes that would be interesting for that investor.
All right. So that's exactly the note that I put down with a question mark against it. Really, it's a matter of scale, isn't it? The kind of the volume. So when you, so is that really the defining difference? You could have an institutional investor will invest anywhere on the risk return profile or spectrum, provided the scale is big enough.
Yeah, to be honest, it's hard to generalize because not every investor, invests the same way. There are some investors that will have no problem investing in any of the different asset types that I mentioned earlier. And then there's some investors that will say, I only want to buy the big shiny office building in a gateway city or a trophy hotel in sort of a key location. So it varies. Like I would say it depends on the bucket.
And what will be the key drivers for them? Security, yield, prestige? Like what's really driving their motivation?
Yeah, no, it's a good question. It's a combination. I mean, depending on the investor, whether it's a sovereign wealth fund investor to global pension funds, endowments, foundations. From our experience and from my experience, I would say generally speaking, the largest investors are a little more gravitated because a lot of them it may not be, it's not domestic capital. It's not in the US, right? So if it's a sovereign wealth fund from Asia, the Middle East or Europe, they'll be more focused on the key gateway cities if they're investing in the United States, right? So like in the US, they're less likely to buy a building in, Kansas City versus New York City or San Francisco or Chicago or LA. So I think there's a bit of a preference from, if I'm generalizing, from non-US investors to buy in key gateway cities in the US. And that tends to be bigger assets because most of these investors are investing large amounts of capital. They can't invest in small deals. So like, generally speaking, most of these investors, they won't even look at a deal if the equity is less than $100 million. Like that, it's not even, it doesn't make any sense. And they're also 892 investors, which gives them a tax benefit.
What's an 892 investor?
These are applied to sovereign wealth fund investors. So if they invest into real estate and own less than 50%, they basically don't pay any taxes. So it's a huge advantage for some of these international investors to invest in real estate, but not own a majority stake.
Interesting. All right. So explain to me what is an institutional real estate investor. You've talked about sovereign wealth funds, but what other categories of institutional investor are there that you deal with?
Yeah, the key categories I think are sovereign wealth funds. So these are obvious, self-explanatory, but basically countries, and whether it's like the excess reserves that they manage or a pension fund on behalf of a country, this capital is often used to invest into real estate and other asset types around the world, from private equity to infrastructure, equities and fixed income. But they are a significant investor in the private equity space. There are endowments and foundations, right? So think sort of your top universities and nonprofits. There are a number of prominent ones that we work with. They're very sophisticated investors. You have global pension funds, so large US pension funds across the United States, in Europe, Asia, the Middle East. Those groups are all very sophisticated investors. And I think the key thing about institution, and actually the last bucket I excluded was family offices. I think large family office investors, I view them as being very institutional because they're doing the same thing that you would see like an endowment or foundation do. They may or may not be that. So obviously depends on the family office, right? Some family offices like are investing, smaller check sizes and not doing co-investments and direct deals. And then there's a number of large family offices that have a very significant real estate program and are doing a number of these deals directly. So I would say those are the sort of the main buckets that make up institutional investors. And, those are the type of investors that we work with at Gaw.
So you've said something a few times. I'm very interested in drilling down on this. And you and I had a long, very interesting discussion last time we chatted about crowdfunding and the differences. So in that context, you've used the word sophisticated, right? So when you sit in front of a sophisticated institutional investor, just describe what that means. I mean, picture yourself in the room, you're raising the next fund, and you are now presenting your case for why they should allocate money to you. What does it mean to be sophisticated in that environment?
Yeah, I think what I mean by sophisticated is the investor is very aware of the opportunities that they could invest in. They know the space, they know the risk return spectrum, they know how much leverage they want to take, and they understand the opportunity that you're presenting where they, and I think that some of that's based on experience, some of that's based on their team, some of it's based on their ability to execute. Some of them are very sophisticated, but they can't execute very quickly. So meaning if you present the deal to some investor, like some of our investors, I could show them a deal. Some of our investors can make a decision on a deal within a week to move forward. There are some that can't make a decision within a month. And so I think that also speaks to a little bit of the sophistication of how quickly they can move. The other thing is like just sort of understanding the opportunity and how like if you've invested in a region or in a product type and you understand and ask the right questions, that'll also come across during a meeting, right? So like if we're meeting with an investor that's never invested, let's say in the United States, then it's not that they're not sophisticated, but they're not going to understand the nuances of the US market if they've never invested here. Just like if you've never invested in Zimbabwe, like you won't understand that market as well. So it's sort of give and take, but they may understand their home market really well. And I think that that's sort of a key difference.
And these are professional investors, right? These are professional fund managers. They spend their entire life. When you're sitting in front of somebody, again, it might seem really obvious to you, but I'm not sure that it is so obvious. But when you sit in front of somebody, when you talk about an institutional investor, you're talking about an employee who is highly skilled and experienced with years, and they are a professional fund manager, right? That's all they do. And they specialize in real estate, presumably, the individuals that you deal with.
Yeah, well, I wouldn't say they're not fund managers, but you're talking about the employees or the staff that work for like a pension fund or a sovereign wealth fund, right? So they I don't think they would call themselves fund managers. They would view us as sort of the fund managers, but they would view themselves as a portfolio manager, or depending on their role, they're either an allocator of capital, or they are managing a direct portfolio in some cases when they're actually buying assets themselves. Like we have some investors that they don't invest in the funds, they invest in assets. So they'll do deal by deal, but they're not going to allocate capital to us at, let's say, Gaw, and Gaw we decide where to invest that capital in a blind pool fund structure. There are many investors that do not do that. That's a very typical structure, but there are investors that say, show us a deal, and then we will underwrite that deal and commit to that individual deal. So whether it be a separate account investment or a co-investment, but those are what we call direct deals versus indirect through a fund.
Through a fund. All right. So when you sit in front of you described, excuse me, the kind of conversations that you have where you might present a deal to an investor who can make a decision within a week, and another one who can make a decision within a month. But what you're describing there are people who know you, with whom you already have a relationship, and presumably have already gone through the entire negotiation process for what the relationship with them is going to look like in contractual terms. Let's talk for a moment, though, about what it looks like to bring a new investor into the Gaw Capital fold, right? What are they looking for, and what does that negotiation look like?
Mm-hmm. Yeah, so with new investors, which we typically are meeting all the time, but less so in the current COVID environment, I would say there's usually sort of a get to know you process. So there's an introductory meeting, whether it be in our office or at their office or at a conference or something. And then we sort of get to know each other. So learn, and oftentimes we're already aware of that investor because we've already done research on them. And I think that's actually something that most people do not really think about. Doing your homework on a limited partner and understanding an investor before you meet them, and knowing their funding ratio, their allocation split to, let's say, in this case, real estate, or the historical investments they've made, can give you a lot of insight into what they're able to do. And I think that that's something that we try to be really thoughtful about. We do a lot of homework on and research on groups before we meet with them, because it just makes us more informed. We know like who we're speaking to. I was just speaking with one of our investors earlier this morning, one of the largest pension funds here in the United States, and they're really, really smart. And we're always in constant dialogue to share what we are seeing, in Asia, for example, and then hearing what they're doing to figure out if there are additional opportunities to work together. But in your question of meeting a new investor, it's generally this get to know you process. And then what we'll do is we may or may not have a product that we're actually pitching. So like if we're in the market, like right now, we're not actively marketing a product, but if we are sharing something, we would sort of go through and describe what that looks like. It's usually, I would say it's generally a firm overview, a description on the fund, and then also either a case study and or the track record, depending on the time for the meeting. But it usually includes those components. And then there's like sort of a dynamic of back and forth Q&A.
And presumably in the same way as you do, you know the investor before you even meet them, or have heard of them and have some awareness of their background and who they are. Similarly, your reputation has preceded you as well. So there is some reciprocal knowledge of who you are going into these meetings.
In most cases, but there are definitely cases where, I mean, I've had calls and meetings with groups that have said, what is Gaw Capital, or who is Gaw, or what is, they have no understanding, or they've never come across Gaw Capital. And I think there's nothing wrong with that. Just if you're, especially in the United States, especially here in the US, I would say it's more common that I'll get asked the question of, so tell me about Gaw, what do you guys do? Versus in Asia, when I was based in Asia, we've got now about, over 25 billion of assets under management, Asia being 3/4 of that. It's hard to, I feel like if you're in the real estate world, it's hard not to really come across Gaw in some respect. So you've probably heard of it. You may not know it really well, but it was pretty common where, like you said, people in Asia would really know the firm, and because there's a lot of big profile deals that the firm has done. So I think it's more likely that someone would recognize the firm in Asia.
It's funny that you should say that, Mike, because when I worked for Goodwin, however long ago it was, I was definitely of the opinion that everybody in the world knew him. So nobody I came across didn't. But let's get back to the way that a negotiation looks. What I'm getting at here is how you actually get to the finish line. So with this new investor, there is a fairly formalized ritual by which you get to know each other, Q&A and meetings and et cetera, et cetera. And then there comes the point where you are pushing across the table a pitch, right? Invest in this fund, or we have a building we'd like you to take a look at, et cetera. And describe that process. How do you now navigate to the close with somebody like that? What does that process look like?
It totally depends on the investor. Some investors, I've had meetings with some investors that have gone out of their way to seek me out or the firm out. And they have said, I want to learn more about Gaw Capital and, your Gateway Fund, for example, the Pan Asia Fund or the US Fund. And they've reached out to us even through like a cold email and just said, I'd be interested in getting to know you. I work for XYZ organization. And, if it's a notable organization, it's very obvious that they're genuine, right? They're reaching out. And so we'll have a conversation, and I would say the process ranges from meeting them, usually doing some sort of on-site meeting and due diligence, from access to a data room for sort of desktop DD to ultimately on-site DD in our office. So that investor and or their consultant, some large, especially large US pension funds, engage in a consultant to do due diligence on their behalf. Okay. And they will do investment level due diligence. They'll also do sometimes operational due diligence, which is ODD. And that means reviewing the back of the house. So understanding how the finance and accounting works, capital calls, distributions, what are the risk and compliance protocols in place. And that's something that, most institutional managers like a Gaw Capital, like we're going to be very familiar with it, because that's the part that most people don't really talk about, because it's sort of the less sexy side of the business, I would say, compared to the sort of the investment side, where people, you just have to have that, right? It's sort of a given. Every investor expects that you do that really well.
That's the admin. You're talking about the kind of the administration side of things, right?
That's right. And so, and going back to the process, so you go through that, and then, and at the end of sort of a due diligence period, that investor goes through usually an investment committee process to approve the investment. Once that's done, or along with that time period when that is approved, you enter into legal documentation. And so then you're negotiating the LPA or limited partnership agreement, to side letters, to other legal docs that are required, and then they're completing a subscription booklet and to finalize the investment.
So there's a couple of things you talked about there that are very interesting. One, you use the term consultants, and then use the term legal documents. Both of these basically speak to outside professionals being brought in as part of the negotiation that you put together when you're trying to close a deal with somebody. So just tell me about that, what that looks like, again, with a new investor. Presumably you put a contract in front of them, and then what, their team of lawyers will respond to that, and then your lawyers will respond to theirs, and etc. Just describe that process a little bit. And the reason that I'm asking you, as obvious as it may seem to you, Mike, that's what people do, is that it isn't that obvious, actually, in the world of crowdfunding. So do drill down, if you don't mind, just a little on what it looks like to have consultants involved and lawyers when you're going through this process.
Yeah, I mean, so the consultants, it's really dependent on the investor, right? Not all investors use consultants. Some, and they use consultants to different degrees. Some rely on consultants and will not make an investment without a consultant's approval. Other investors use the consultant to augment their own due diligence. Others will have them only focus on certain parts, whether it be the ODD or investment DD portion, or on-site DD or whatever it is. Like it's maybe just a small portion. And then some just say, we don't use consultants, we just do it all in-house. And they have a team that is capable of doing the investment themselves and underwriting themselves. You know, the legal due diligence or the legal documentation is the back and forth typically between our lawyers and their lawyers, along with business counterparts. So like myself and the investor would ultimately join for the business points. There are different sort of hot buttons, I would say, that people will touch on, but it really depends on the investor, and it depends on how specific they are with certain legal requirements. Some, like legally, are not able to invest in certain spaces or geographies, et cetera. And they'll just say, look, we can't do it. We have to have a carve out for that. Others will just say we have a preference, for example, for leverage to be lower or whatever. And I'm making examples up, but like
right.
They could say something and you either choose to accommodate it or you don't. And as the manager, as the GP, if you don't want to agree to that, you have to be willing to potentially lose that investor, because that investor, not all investors, as you know, will just sort of sign the docs and sort of take it or leave it type situation. And that's quite different, you know, when you're dealing with this sort of negotiation process.
Right, and there are presumably, and then we'll move on from this point, but it's very interesting. But presumably there are certain major decisions that you need to consult with investors on in order to be able to execute. Would that be fair to describe?
It depends. So not in a fund structure. If it's in a closed-ended fund structure, we have discretion over that capital. So if it's discretionary capital where they're investing it into a fund, Gaw has the mandate to invest. Let's say it's $1 billion of capital, we can invest it. There's a mandate of where like the strategy of how we can invest that. So you don't want to have like strategy drift, obviously. So if you start investing in logistics in Brazil, but you're investing a US fund, obviously that doesn't make any sense. But it's not what you described as if you're doing like a separate account investment. And if you're getting capital to buy, let's say, an office building here in Los Angeles, then generally speaking, if that investor is coming in for, let's say, 95% of the equity of that deal, that investor would definitely expect to have major decision rights. And there are a number of things that they can negotiate for in that situation.
Now, you are a fund manager, is that correct? Like you're the general manager of funds. You put funds together. What's your, what would you describe it? 'Cause I mean, there's so
Yeah,
many
so
different,
Gaw,
yeah.
yeah, no. So Gaw Capital, we are the general partner or the GP of these funds. So we are managing and running these funds. I'm the head of our U.S. capital markets team, so I focus on fundraising, co-investments, and separate accounts. But that's sort of Gaw's role in this structure is to be the GP and to manage these investments
Okay,
and be a
so
fiduciary for our investors.
okay, so what do institutional investors look for in a GP when they're looking to invest, presumably in the same way as you're looking for investors or talking to investors on a daily basis, investors are looking at GPs on a daily basis.
Yep.
So what are they looking for, and how do they make sure what they see is what they're going to get?
Yeah, no, it's a good question. I think they're looking for GPs with a good track record and with a strategy that they can underwrite and understand. That's really they're focused on sort of the best teams, and I think that's what people are focused on when they're meeting with different managers.
So that was again, you did blip out briefly, but I will just paraphrase. So good track record, and also an alignment with their investment strategy. And so how do they determine that you have a
That's right.
good track record? Right? I mean, you say, look, here's our presentation. It's more than just, oh, that's nice. Yes, great. We're satisfied now, isn't it? Tell me a little bit more about what they really do.
Yeah, they want to see your track record in terms of like what are all the deals that you've done, and what's the performance of those deals, right? So assuming you sold some of those, you will have harvested and you'll have some returns that you can show. If you haven't sold them, they want to see what are the mark-to-market returns, and or projected returns. So that's what they're looking at when they're looking at their track record, at someone's track record. They basically are saying, show us everything that you've done to date, because we want to know your good deals and your bad deals.
Really?
Yeah.
And then will they ask for references? Will they visit sites? I mean, how do they verify what you're telling them is
Yeah,
true?
they do both. They'll do both of those.
Really? So how
Yeah.
long is the process then from let's, on average, I know there's going to be a range, but from the first contact with an investor that calls, you make first contact with to closing a first deal with them, you figure?
I mean, we've done it, I would say it could be as quick as 2 months, like 2 to 3 months would be sort of, I would say, warp speed. Um,
Right.
and then there's some investors, honestly, like there's some investors that I'm not exaggerating. There's some investors that we've closed and we've been able to get into one of the Gaw funds or vehicles that we've been speaking to for 10 years.
Really?
Yeah. There's a huge range.
That's incredible.
Yeah.
And so what holds them back then? What are they
So,
waiting for? Is it, yeah.
yeah, so sometimes it's just like change in their strategy, uh, uh, change in their leadership team. Sometimes will change the strategy. Sometimes just, I would say, change in economic climate. Like, for example, today, I would argue that if you're comparing the world right now and let's just say you have the ability to invest globally, I would say in my personal opinion, there's a much stronger argument for making an investment in Asia today than the United States. And I think that's partly because if you look at what's happened in Asia, things have actually rebounded very quickly. Everyone in our 11 offices in Asia are back in the office, and everything is back to normal. People are not traveling across multiple countries, but they're traveling within their country. Factories are open, restaurants are open, movie theaters are open. I was actually just in a meeting with Goodwin yesterday in our office, who happens to be in town. He happened to be in town, and we were saying how the US is virtually shut down. I mean, I was in the office yesterday, but our offices are closed and you can't open, restaurants aren't open, et cetera. Movie theaters aren't open. And it's a real, I mean, schools aren't even open, right? Like my kids are at home doing virtual school. I think that this is a big change that is going to really, I worry it's going to negatively impact us here in the US for a very long time, because it's going to take some time before, a vaccine can be rolled out. And the experts are saying sort of summer of 2021. But that's a long time for us to be stuck at home, and, kids not going to school and not being able to sort of move forward with our sort of, with some normalcy. Versus in Asia, everything is basically, I mean, when I talk to our colleagues, like to give an example, this year, since the beginning of this year, Gaw has invested over $3.5 billion in Asia. We've sold over 1.2 billion of assets in Asia. So we've been very busy, and it's been like, people aren't that worried about how things look in Asia. But I think in the US, like, there's definitely some more concern.
That's interesting. So actually, that brings me on, and we should start wrapping up now, because I know for both of us, we want to give bandwidth back to our children. So what are the biggest risks in institutional investing, both from an investor and a GP perspective?
I think that from a GP's perspective, the biggest risk, which is a risk, but also can work as both a plus or a minus, is the investors that are long-term type investors usually have long-term patient capital. However, there are some things that can impact a long-term investor to have them make short-term decisions. So, for example, right now, let's say like during March, right, when the equity markets were in a free fall, as the equity markets drop, that actually decreases the equity portfolio. It's called the denominator effect, but it basically decreases their equity portfolio, increases the value of their real estate portfolio, and that goes above a certain threshold. For an institutional pension fund or institutional investor that has a certain allocation where they need to stay within that window, they may be forced to sell certain assets during that time period, which may be the wrong time to be selling. And that is something that could negatively impact you as a GP, because they could have to sell certain assets that they don't want to sell at that moment in time. I think that the negative for the institutional investor is I think that they're not always as nimble. There's usually more bureaucracy. If you're talking about like a pension fund or a sovereign, they're just not like an endowment or foundation or a family office, right? Where maybe it's like a single principal that just makes a decision and says, we're investing in that deal. It's quite different. So I think that sort of nimbleness and also probably, going back to when you were saying scale, like they're not going to be typically investing in $5-10 million deals, because it's not worth their time. It takes the same amount of work as investing into $100 million deal. So that's sort of the drawback.
Mike, it's a real pleasure talking to you. Let's wrap up with 3 rapid fire questions, if you don't mind. I ask all my guests the same 3 rapid fire questions. The first one of those 3: what are your key daily habits, personal habits, that keep you successful?
A nice strong cup of coffee, a little bit of exercise, and just being able to read the news, I think helps me sort of digest what's going on in the morning. And those are sort of habits that I have every day.
A caffeine achiever, just like me. Second question: what's been the hardest lesson you've learned in real estate?
The hardest lesson I've learned, I would say probably knowing when to sell. I think that most people are not that disciplined about it. And I think that's where you can often have a great investment turn into a mediocre investment.
Last question. What advice, and we talked about crowdfunding last time when we chatted, So what advice would you give to somebody who's looking at a deal, being told that the deal is an institutional quality deal or an institutional quality sponsor, etc.? What advice would you give to them as they decide whether or not to invest in that deal?
I think that they should do their own homework on it. So I think they should look into who is the manager, what have they, like, where have they invested, what is their track record. They should treat it as if they are an institutional investor putting capital out and understanding the deal, drilling into the numbers, and just taking a look. Does it make sense? Because oftentimes a lot of people don't. They just look at the projected returns and just sort of take it at face value. And I think that you do have to do that. It's obviously takes a lot more time, but I think spending the time to do your own due diligence will often uncover things that you won't see just on a piece of paper.
Mike Hugh, Managing Director, Capital Markets, correct, at Gaw Capital USA. Thank you so much for joining me today.
No problem. Thanks for having me, Adam. Appreciate it.
That was Mike Hugh, Managing Director, Gaw Capital Advisors USA. As I mentioned, we're in the process of creating some new training. Normally, I would suggest you go and watch the whiteboard workshop at gowercrowd.com. Definitely do that. But be sure to sign up for the newsletter there, either as an investor or as a developer. There are both options that you can choose from. And I will send you some new training that we have coming out any day soon. I'm just not sure exactly when, but we will announce that in the newsletter. And of course, check out the podcast page for links to Mike, my guest, Mike Hugh today at Gaw Capital, and to a series of short video segments so you can see the highlights from today's episode. All right, that's it. Thanks for listening. And thank you, Mike Hugh, Managing Director, Gaw Capital Advisors, for your time with me today. It was a real pleasure meeting you. Really appreciate the time that you took out and for the insights that you shared with us. It was a real pleasure. That's all for this episode. I'll see you next time. And in the meantime, stay well. And for now, this is Dr. Adam Gower signing off.